October 19th, 1987, 7:45 a.m. A portfolio manager walks into Stanley Druckenmiller's office. The guy is sweating, not normal stress sweating, the kind of sweat that comes when you realize you're about to lose everything. He built a $500 million position in blue chip stocks. IBM, General Electric, Coca-Cola, solid companies. But he didn't use his own money. He borrowed $300 million at 8% interest to amplify his returns. The math looked perfect on paper. Stocks returning 15%, debt costing 8%. 7% free money, he called it. Then Black Monday hits. The Dow crashes 22.6% in a single trading session, the largest one-day percentage decline in stock market history. His $500 million portfolio becomes $380 million by market close, but his debt, still $300 million, still demanding 8% interest, still requiring monthly payments. 9 a.m. Tuesday morning, the margin clerk calls. Cover your position or we liquidate everything. He doesn't have the cash. For sale. By Wednesday afternoon, 40 years of wealth building erased. Zero. Not because he picked bad companies, because he used leverage during a liquidity crisis. Druckenmiller survived that week because he was carrying zero debt, zero. While brilliant investors were getting margin calls and career-ending losses, he had cash. He was buying their forced liquidations at 40 cents on the dollar. Why does this story matter right now? Because in February 2026, American households are carrying $14.9 trillion in total debt, credit cards at record highs, margin debt and brokerage accounts approaching 2007 levels. And the exact three conditions that triggered the 87 wipeout are back. High interest rates, expensive valuations, and tight liquidity. If you're investing while carrying debt above 5% interest, the next 9 months could erase years of gains in a matter of days. This isn't theory. This is pattern recognition from 40 years of watching brilliant people destroy themselves with one simple mistake. By the end of this breakdown, you'll understand the 4 debt traps that wipe out investors even when the math looks perfect. You'll see the exact framework Druckenmiller uses to decide when debt is acceptable and when it's financial suicide. And you'll learn the 3 specific warning signals that tell you it's time to stop everything and pay down debt immediately. But first, you need to understand why everything your financial advisor told you about debt is dangerously wrong. Here's the advice everyone gets. Compare your interest rate to expected market returns. If your debt costs 5% and stocks return 10% historically, invest instead of paying off debt. You pocket the 5% difference. Sounds logical, sounds mathematical, sounds safe. Druckenmiller calls this the most dangerous lie in personal finance, and he's watched it destroy more wealth than any market crash ever has. Here's what that advice ignores. The 10% stock return is an average calculated over 90 years. It includes the roaring 20s, the post-war boom, the tech revolution, and the everything rally of the 2010s. But it also includes the Great Depression, the 1973 to 74 crash, the 2000 to 2002 bear market, and the 2008 financial crisis. In any single year, stocks might return 40%. Or they might drop 35%. The returns are volatile, uncertain, and completely unpredictable in the short term. But your debt payment, that's due next month at exactly 5% compounded. Certain, relentless, never takes a vacation. Let's run the real math that financial advisors don't show you. You have $30,000. You're carrying $30,000 in student loans at 6% interest. Your advisor says, invest the money, market returns 10% average, you net 4%. Easy decision, right? Year 1, market returns 12%. Your $30,000 becomes $33,600. You made $3,600, but you paid $1,800 in loan interest. Net gain $1,800. You're ahead. The strategy works. You feel smart. Year 2, market drops 20%. Your $33,600 becomes $26,880. You lost $6,720. Plus you paid another $1,800 in interest. Total damage, $8,520 gone. Your original $30,000 is now $21,480. But you still owe the full $30,000 in student loans, so your net worth isn't $21,480, it's negative $8,520. You're underwater, and now you're forced to choose. Sell your investments at a massive loss to pay down debt, or keep paying 6% interest on $30,000 while your portfolio is down 20%. This is the trap, and here's the part that destroys people. You can't handle the emotional pressure. You panic. You sell at the bottom, you lock in permanent losses, the debt wins. Now run the alternative scenario. You use that $30,000 to pay off the student loans completely, zero debt. Year one, you saved $1,800 in interest, guaranteed return of 6%. Year two, market crashes. You're not invested, so you don't lose anything. But more importantly, you have no debt payments. Every dollar you earn now is yours to invest at the bottom. While everyone else is forced to sell to make debt payments, you're buying. The crash that destroys leveraged investors becomes your buying opportunity. That's the difference between surviving and thriving. March 2008, Bear Stearns collapses on a Friday. By Monday morning, credit markets are frozen. Banks aren't lending to each other. Margin calls are going out across Wall Street. Hedge funds are liquidating positions at any price just to raise cash. Stanley Druckenmiller is on the phone at 3 a.m., but he's not panicking. He's not scrambling to meet margin calls. He's not begging banks for extensions. He's buying aggressively. Companies trading at 50 cents on the dollar. Real estate at 40% discounts. Assets that will be worth double in 18 months being sold by desperate investors who have no choice. How is he buying when everyone else is selling? Because 6 months earlier, he moved 35% of his portfolio to cash. Not because he predicted the exact timing of the crash, but because he saw the setup. High leverage across the system, tight credit conditions, expensive valuations, the ingredients for a liquidity crisis. When the crisis hit, he had zero debt and maximum cash. The combination gave him something priceless, optionality. He could wait, he could be patient, he could act rationally while everyone else was forced to act desperately. 16 hours after Bear Stearns collapsed, Druckenmiller was up $260 million. Not from luck, from positioning. He eliminated debt. He built cash. He waited for forced sellers. Then he bought. The investors who got destroyed that week weren't stupid. They were leveraged. They had margin loans. They had mortgages they couldn't afford without selling stocks. They had debt payments due regardless of market conditions. The debt eliminated their optionality. And without optionality, you can't survive volatility. This brings us to the 4 debt traps that destroy investors. These aren't theoretical, these are patterns. Druckenmiller has watched repeat for 40 years. Debt trap 1, high-interest consumer debt. Meet Sarah, 32 years old, marketing manager earning $75,000 per year. She's got $15,000 in credit card debt at 18% interest. She's also investing $500 per month into index funds because her financial advisor told her to start early for compound interest. Here's the math she's not seeing. That $15,000 in credit card debt is costing her $2,700 per year in interest, but she's investing $6,000 per year. If her investments return 10%, she makes $600. Net position, negative $2,100. She's bleeding money while thinking she's building wealth. Over 5 years, if she keeps this strategy, she'll pay $13,500 in credit card interest while making approximately $3,000 in investment gains. That's $10,500 destroyed, not lost to market crashes, just mathematically eliminated by carrying high-interest debt while investing. Now run the alternative. She stops investing completely, takes that $500 per month and attacks the credit card debt. $15,000 paid off in 34 months. Then she starts investing that $500 per month plus the $225 she was paying in minimum payments, $725 per month invested for the remaining 26 months. End result after 5 years, zero debt, $12,000 invested, and every future dollar compounds without interest payments, bleeding returns. She's actually built wealth instead of creating the illusion of wealth. Druckenmiller's rule is absolute here. Any debt above 8% gets paid off before one single dollar goes into investments. No exceptions. No strategies, no arbitrage attempts, just pay it off. Because mathematically, you cannot reliably beat high interest debt with stock market returns after accounting for taxes and volatility risks. Debt trap 2, the opportunity cost illusion. Meet John. He's got $40,000 saved. He's got a car loan with $40,000 remaining at 5% interest. His buddy who works in finance tells him, invest the $40,000, keep making car payments. Stocks return 10% long term. You'll net 5% free money. John follows the advice. Here's what happens. Year 1, his $40,000 investment becomes $44,000. He made $4,000 in gains. He paid $2,000 in car loan interest. Net ahead, $2,000. The strategy works. He tells his buddy he was right. Year 3, recession hits. His portfolio drops 30%. $44,000 becomes $30,800. He's down $9,200 from his original amount, but he still owes $28,000 on the car loan, and he still has to make that $400 monthly payment. His company announces layoffs. He's worried about his job. The $400 car payment that seemed manageable when markets were up now feels like a noose. If he gets laid off, he's forced to sell investments at a 30% loss to make payments. The optionality is gone. But here's what really destroys John. The mental cost. He's constantly checking his portfolio, calculating whether he should sell to pay off the loan, worrying about next month's payment. He misses a major buying opportunity and beaten down stocks because he doesn't have available cash. Everything's tied up, and he can't think clearly because debt is occupying his mental bandwidth. This is the hidden cost that never shows up in spreadsheet calculations. Debt creates mental overhead. It forces short-term thinking and eliminates patience. And in investing, patience is your only sustainable edge. Quick pause here. If you're realizing debt is costing you more than just the interest rate, hit subscribe. This channel breaks down how elite macro investors like Druckenmiller actually think about risk, leverage, and capital allocation. No hype, just forensic analysis of what actually works. Now let's talk about when debt becomes acceptable. Druckenmiller doesn't say never carry debt. He says understand exactly when debt is a tool versus when it's a weapon pointed at your own future. He uses a 4-scenario framework. Each scenario has a different answer. Scenario 1, any debt above 8% interest. Credit cards at 18 to 24%. Personal loans at 12%. Payday loans at triple-digit rates. The answer is always the same. Pay this off first, every available dollar. Stop all investing until this debt is gone. Why 8% specifically? Because after taxes, stock market returns average about 8% for most investors. You're in the 22% tax bracket. That 10% historical return becomes 7.8% after capital gains tax. Any debt costing more than 8% is mathematically impossible to overcome with investing. Scenario 2, debt between 5 and 8% interest, student loans, car loans, some mortgages. This is where Druckenmiller applies the 50-50 rule. Take your available capital. Half goes to debt payoff. Half goes to investing in diversified index funds. Why split it? Because you're eliminating the all or nothing risk. Market crashes, you still reduce debt. Market soars, you've participated in gains. You're building wealth while reducing vulnerability. Neither strategy fails catastrophically. Scenario 3, debt under 5%, mortgages in low-rate environments, 0% promotional offers. You can carry this while investing, but only if you pass the 3 tests. 6-month emergency fund in place. Investing in diversified indexes only, not individual stocks. And genuine ability to handle 50% drawdowns without panic selling. Fail any one test, pay off the debt first. And for 0% promotional debt, one absolute rule. You must have the full payoff amount sitting in a separate account before the promotion ends. Miss this and that 0% becomes 23% retroactive on the entire balance. The credit card company wins. But here's a signal that tells you it's already too late to take the gradual approach. When any of these three warnings trigger, everything changes. Maximum debt payoff mode immediately. Signal 1. Interest rates on new borrowing cross 6% and stay there. Right now, in February 2026, mortgage rates are 6.5%. Credit card rates are above 22%. This is a red alert environment. Why 6%? Because above this threshold, two things happen simultaneously. First, your variable rate debt gets more expensive. Second, you lose the ability to refinance into lower rates when you need flexibility. You're trapped. If rates are above 6% and you're carrying any variable rate debt, every available dollar goes to principal payoff, not investing, not saving for vacation. Debt elimination. Because at these rates, debt grows faster than safe investments can overcome. Signal 2. Your debt-to-income ratio exceeds 35%. This is your total monthly debt payments divided by gross monthly income. Above 35%, you're in the danger zone. Calculate this right now. Add up mortgage, car payments, student loans, credit card minimums, everything. Divide by your gross monthly income. If the number is above 0.35, you have no margin for error. One unexpected expense, one income disruption, and you're in a death spiral of more debt to pay existing debt. Above 35%, financial flexibility disappears. You can't handle volatility. You can't wait for opportunities. You're forced to react desperately to every market move. This is where investors get destroyed. Signal 3. You're using debt to invest, margin in your brokerage account, cash out refinance to buy stocks, personal loans to fund crypto purchases. This is the ultimate red flag. You're not investing anymore. You're gambling with borrowed money. 1999, tech bubble peak. Druckenmiller watches hedge fund managers borrow heavily to chase internet stocks. They're making 50%, 80%, 100% returns. The pressure to keep up is intense. He adds modest leverage to participate. March 2000, bubble pops. NASDAQ drops 78% over 2 years. The leveraged managers get margin calls in the first 30 days. Forced liquidation at massive losses. Several go bankrupt. Billionaires to zero in months. Druckenmiller survives because his leverage was small and he cut it immediately when he saw momentum break. But he watched people smarter than him get completely wiped out. The lesson burned in his brain. Never borrow to invest. If you can't buy it with cash, you can't afford the risk. Let me show you what this framework looks like in real life. 2023. A 38-year-old software engineer reaches out to Druckenmiller after a conference. He's got $200,000 in index funds. He's also got $150,000 in student loans at 7% interest. He asks the question everyone asks: should I keep investing or pay off the loans first? Druckenmiller's answer is immediate. Pay off every dollar of that loan before you invest another cent. The engineer pushes back, but the market returns 10%. I'm losing 3% by paying off 7% debt instead of investing. Here's what Druckenmiller tells him: that 7% on your loan is guaranteed. You will pay $10,500 in interest this year. Certain, no volatility. The market might give you 10% this year, or it might drop 30%. Which one can you bet your financial future on? The engineer takes the advice. Stops all investing, attacks the debt aggressively. 2 years later, loans completely paid off. Now he's investing $12,000 per year with zero obligations, no monthly payments, no interest bleeding his returns, just pure compounding. Year 3 market crashes 40%. His portfolio drops from $70,000 to $42,000. But here's the difference. He doesn't panic. He doesn't sell. He doesn't have debt payments forcing his hand. He keeps investing. He buys more at lower prices because he has no debt demanding cash regardless of market conditions. 5 years after that conversation, his portfolio was worth $280,000. If he'd kept the loans and invested simultaneously, accounting for the interest payments and the forced selling during the crash, he'd have $190,000. That's $90,000 of extra wealth. From one decision, pay off the debt first. That's not theory, that's the actual math of how debt destroys compounding while making you think you're being clever. The brutal truth that nobody wants to hear is this: debt doesn't just cost you the interest rate, it costs you something far more valuable: the ability to think clearly, act rationally, and survive long enough for compounding to work. In 2008, the investors who built generational wealth weren't the ones with the highest returns in 2007. They were the ones with zero debt and maximum cash when the crisis hit. They could be greedy when others were fearful. They could buy when everyone else was forced to sell. Debt eliminates that option. It converts you from an investor into a forced reactor. And forced reactors always lose to patient accumulators. Druckenmiller has said the best investment he ever made wasn't Berkshire Hathaway or shorting the British pound or any specific trade. It was the decision early in his career to live below his means, eliminate debt quickly, and build a foundation of financial independence that gave him 40 years of clear thinking. That's the real answer to whether you should pay off debt or invest first. You're not choosing between two financial strategies. You're choosing between fragility and anti-fragility, between forced reactions and patient opportunism, between surviving the next crisis or becoming a statistic in it. The math is clear. The framework is tested. The only question left is whether you'll act before the next liquidity crisis makes the decision for you. Drop a comment right now and tell me which story hit closest to home. Sarah bleeding money on credit cards while thinking she's investing smart? John trapped by the opportunity cost illusion? Or the 1999 leverage managers going from billions to zero? Want to see which